No rate hike. The Federal Reserve leaving interest rates unchanged. This is Janet Yellen's final FOMC meeting as Fed chair. Here now with reaction is Real Money contributor Stephen Guilfoyle. All right, Stephen, good to have you here.
Nice to be here.
No surprise on the rate hike decision, but the economic data out there is hot. The Fed needs to move at some point soon.
Yeah, there's a couple of things here in the statement that I noticed here. Number one, gains in employment, household spending, and business fixed investments have been solid. That's an upgrade from moderate in December. So they basically feel there's a hotter sentiment out there. Number two, market-based measures of inflation compensation have increased in recent months but remain low. So they see a little bit of inflationary pressure there. And three, inflation on a 12-month basis is expected to move up this year. Last month, that inflation on a 12-month basis is expected to remain somewhat below 2%. So they've upgraded in three areas, at least that I caught so far on the primary glance at the statement.
But still, inflation remains low. When we look at yields on the 30-year bonds, that kind of gives us a good gauge of where the markets think inflation is going. We're still below 3%, and we actually took a notch to the downside on the 30-year yield following this report.
That's really incredible. I mean, think 30 years out, and you're not even going to get 3% for that investment vehicle. I think the hottest story today is the 10-year, which is running a little bit below 2.75%. We would like to see that spread between the 2 and the 10 get above 60 basis points. It was actually above 60 for an eyelash last night when the president was speaking. It went back below today.
And just to interject, the 10-year now has reached its high of the session right now at 2.746%. We came off
or it's
the
low
highs.
of the session, depending how you look at it.
Well, there you go.
Right. So that's very interesting there. There seems to be downward pressure on bonds, which is interesting also because due to the pension fund rebalance, there actually has to be an inflow of bonds coming in this afternoon, most likely something to the tune of $16 billion, which will warp those rates going into the close.
Now we're at 2.748, and yet stocks are holding up nicely, certainly compared to what happened yesterday.
Well, they're holding up nicely. And again, I have to bring up that pension fund rebalance. We had two serious days to the downside. We're not even close to recapturing even half of what happened yesterday. There still is probably some of that money out there that has to move out of those pension funds and rebalance going into tonight's close. So I don't think we're out of the woods by any stretch on what is it down now to up 119. I think we're in serious danger of seeing that go below a plus 100 shortly.
So how does this change your outlook on the markets? I mean, what are you thinking about from your portfolio's point of view?
Well, you know, tech's still my leader. I don't think that changes at all. I think growth is very good for tech. I like all the things about tech that you guys here at the street like. I like the AI. I like the cloud. I like the blockchain mining. I like artificial intelligence. I think you have to be in the semis. You have to be in the companies that make products for the semis. I think you need stocks like Microsoft, even IBM now I've gotten into. I think you need to be in energy as well. Now $64 has been huge for WTI crude. It actually cracked to the downside earlier, but they came off it after 3 tests today. That's the gateway. $64 is the gateway. 62 is a little bit of a bust stop, but 60 is the next stop if it cracks.
All right, what about financials? Obviously, when we're examining rates, you have to think about financials.
To be honest, yes, I have exposure to the banks. I want to have exposure to the banks. I don't have quite as much as some other people. I need this spread between the 2 and the 10 not to get to pop over 60 basis points. I want to see it at 80 basis points. Then I'll feel much more comfortable with the banks, but I do want to go there.
Let's reflect on Janet Yellen's tenure as Federal Reserve Chair. The stock market, the S&P 500, I just looked at the numbers before we went on, up 57% from when she started in February of 2014. That's incredible.
Yeah, you know, I really was kind of hard on her in my writings over the years, and I was thinking about it this morning. If you read my note this morning, I went kind of easy on her, and for good reason. I actually sat down and I thought, you know, if I was the head of the Federal Reserve the last 4 years, my 401k would be nowhere near where it is now, and we'd probably be coming out of a recession because I would have raised rates in 2013. So we would have been ahead of the curve if you had an Austrian thinker such as myself running the central bank. Instead, we had quite a dovish thinker, but a cautious one, and that helped. And I think Ben Bernanke gets a lot of the credit for saving this country during the coming out of the recession, and he'll be the first to tell you. But I think that Janet Yellen was there every step of the way and actually coddled the recovery in a much better fashion than he did.
You say Janet Yellen was cautious, but she was an academic At heart, Jerome Powell is not an academic, right? He comes from Wall Street, the private equity space. What does Powell need to do, and he, of course, takes over in just a few days, to continue the momentum that Yellen has sort of built?
Well, everyone thinks he's a Yellen clone or Bernanke clone. He's never disagreed with them really on anything, but he does come from the private sector, which to me means he probably will react quicker to inflation if it rears its ugly head.
Meaning what, with rate hikes?
Yes, but don't forget, we have the balance sheet. It comes around April, we start extracting liquidity instead of adding liquidity. So we're going to have this rate hike in March. Everyone pretty much agrees March 21, rate hike. Now, if you follow the futures markets in Chicago, we're also looking at June and maybe December for rate hikes, which would fit nicely with the dot plot. The dot plot was what, 2.1 for the end of the year? That's 2.2 or something like that. So it gets, April is the wild card when this becomes tightening. It's not in here. They're not going to mention tightening the balance sheet there, but it is going to impact the market at some point, the economy, I should say.
Well, so essentially you're saying April will be the first time since the recession that we don't have a Fed adding to the balance sheet. What does that mean for the markets?
It's going to be a test. The markets are going to be tested going forward. I think that on the surface, Janet Yellen probably would have been better for the market. I think you've heard that elsewhere as well. But this is a businessman, which could prove better in the long run, maybe in the longer run with a more pragmatic individual. Not that she wasn't pragmatic, but that I think he has potential to be very pragmatic. I think that you might foster a longer run period of growth.
Janet Yellen sort of famously said last year that the unwinding of the balance sheet will be like watching paint dry. Do you think Powell shares those views?
Well, the mere fact that it's not in the statement means they want us all to think that. They want it to run in the background without anyone really having to think about it. And I really hope they're right. I hope that my stop sign in April, which that shouldn't stop the markets, but it will get larger and larger as we roll along. I really hope that this is something that happens in the background and we almost forget about it when we do these interviews in a year.
All right, when we have a jobs report coming on Friday, the ADP numbers this morning were way above expectations. What are you looking for on Friday?
Robust. I had been looking for an NFP number of 180 this week, and I think that's pretty close to consensus. I think that you'll still see a participation rate around 62.7. Wage growth is still going to be around 2.5. Unemployment, even though it's the phoniest number in the world, is going to be 4.1. I don't think you'll see any big changes here, but it will be supportive of that next rate hike.
And just to wrap here, again, I keep going back to the 10-year yield, now at 2.754.
Wow, above 2 3/4.
Exactly. So I guess what level in the 10-year would hurt the case for owning equities?
I think that it's the first time that traders will become cognizant of this, because I don't think this is why we sold off the last few days.
You don't?
No, I think it's the pension fund rebalance. It really got the ball rolling, and then you got some people that were nervous. You know, I deal with a lot of retail investors because those are my followers. Those are the people I talk to on emails, and they've been quite concerned. And I think that the concern over this outflow exacerbated and caught a little fire over the last 2 days. And as I said, I don't think we're really out of the woods as far as that goes till tomorrow. I think tonight's close could be dicey.
All right. Well, hey, we're still up 6% in the S&P 500 so far this year, so we'll take that.
Thank goodness.
All right. Stephen Guilfoyle, always great to have you here. Thank you.
Thank you.